Hello, and welcome back to Principles of Accounting 2. I'm your host, Dr. B. Today we're going to be talking about flexible budgets and standard costs. Last week we had a nice conversation on the framework for master budgeting. We talked about how the budgets allow the business to spend. It's kind of like a roadmap, right? It's a set of guidelines. It says, hey, this is the amount that you have budgeted for this line item, and this is what you can spend on it. We talked about how everything starts with the sales budget. We start with the sales budget. The budget then is the budget is that starts at the sales. We budget for our projected sales. Then it goes into this the budget for production. The budget for production includes a budget for direct materials, a budget for direct labor, a budget for overhead. And those things help to drive the budget for the rest of the income statement, essentially. And so that's what the master budget shows us. Today, we're going to talk about how these budgets can be flexible, and we'll talk about how we compare that budget to what we call the standard costs. And when we talk about standard costs, I want you to think of standard costs as being this is the cost it normally is. Standard, right? This is the cost it normally is. Standard. And the standard cost is oftentimes not the actual cost. You might want to think of standard cost as maybe being the budgeted cost or what the cost it normally is. But sometimes it'll be different from the actual cost. And that's where the conversation will take us today. So without further ado, let's go ahead and jump into it. Okay. So I want to talk about budgeting from the perspective of flexibility. Just like we talked about last week, the master budget that starts with a sales budget derives a production budget, which then derives the rest of the budgeting process for capital budgets, for the cash budget, for the rest of the income statement budget. Within that budgeting process, there are really two alternatives to budgeting. One is called a fixed budget, the other one is called flexible. Fixed budgeting is also known as a static budget, which means it does not change regardless of the level of activity. Fixed or static means it does not change regardless of the level of activity, meaning I cannot make changes to that budget regardless of what happens. Certain businesses and agencies will use fixed budgeting. For example, the government uses a fixed budget. They do not adjust their budgets during the year. They say, this is what the budget is. We either meet it or we don't. You might go over the budget. You might come under the budget. You might meet it where it is. But we will not change our budgeted amounts based off of activity. That's called a fixed or a static budget. And governments are notorious for using that approach. Most government agencies use that approach. Smaller companies, private companies, typically use what we call a flexible budget. We can adjust our budget based on changes that happen throughout the year. Like, for example, I might generate more sales than I had originally thought. And if I do that, if I sell more than what I had planned for in the production budget, I can increase the production budget. It's flexible. Think of like a stove, right? The stove has the knobs, and you can adjust the temperature, the heat that's coming out of the stove. And so a budget kind of works the same. A flexible budget works the same way. You can adjust the percentages of the budget line items based off of the changes in sales, right? And so that's a concept behind a flexible budget. Now you might say, well, Dr. B, is it better to go with a fixed budget or a flexible budget for my company? It depends on what your company's objectives are. But for the most part, a flexible budget is always best because we can make adjustments to the budget based off of the changes that happen in sales. So here's an example of a fixed budget based off of performance. Now we see in the left column it says fixed budget, right? So that's the fixed amount. Uh, those are the amounts that do not change regardless of the level of activity. I budgeted for $100,000 in sales, and I stuck with that. I actually came in with $125,000 in sales. The difference or the variance is $25,000 favorable variance. Now let's talk about variances for a second. The word variance means difference. The word variance means the difference. That's all. It's very straightforward. Variance is a fancy word. It means difference. It's the difference between the fixed or the estimated budget, we could say it's the difference between the budget and the actual results. A variance is a difference between the budget and the actual results. That's what a variance is. The variance is the difference. And the variance could either be favorable or unfavorable. A variance could be favorable if it favors the company, meaning it benefits the company. If I came in $25,000 above my budgeted amount for sales, well, that's favorable. That means I sold more than I planned on selling. That's a good thing. So that's favorable. However, if my expenses, my costs are above the budgeted amount, that is not favorable, right? We don't want to spend more than what we planned on spending, but sometimes we do. And when that happens, it's not favorable. So that's why, for example, you see direct materials, direct labor, I'm over 3,000, I'm over 5,000, budget compared to actual results. That's unfavorable. I spent too much in materials and labor. Same with overhead. Unfavorable, unfavorable. And then look at the expenses. My expenses were higher than my budgeted amount, so those are unfavorable. My total expenses were 11,600, unfavorable. Okay, so that's not so good. But my sales are 25,000 above what I had budgeted for. That's favorable. So we can find that the total net income is a favorable variance. The 25,000 minus the 11,600 gets me to 13,400. The 13,400 is a favorable variance. Why? Because my sales variance was greater than my expense variances, which means the total variance is favorable, 13,400. Does everyone see how we derive that? Makes sense, right? Yes, no, maybe. Y'all good? You can still hear me, right?
Yes, we can still hear
Okay,
you. Yes,
cool.
we're good.
All right. Okay, just making sure. So it's important to understand how the variances work. That's what I'm getting at. Uh, so the variance is favorable if it's the sales actual is greater than the budget. It's unfavorable if the actual expenses are greater than the budgeted amounts. The nice thing is with flexible budgets is that I can adjust the budgeted amount based off the actual performance. I can say, oh, what if my sales were to increase? I can increase my budget for sales, and that will minimize the variance. And I can do the same for expenses, right? I can increase my expenses budgets, and that would minimize the unfavorable variance for expenses. And so that's the nice thing about having a flexible budget is that you can make adjustments to the budget based off of what actually happens or what you think will actually happen. So when we prepare a flexible budget, we're looking at the uh, cost behavioral changes based on the level of activities. What I mean by that is a flexible budget identifies different levels of activity, and we can change the budget based off of those levels of activity. For example, well, I budgeted $100,000 for sales, so that's 100%. Well, if I come in at 75,000, that's 75% of 100. Okay. If I come in at 125,000, well, that's 125% of the budgeted amount. So what I can do is I can change the budgeted amount based off those percentages of sales. So that's what makes a budget flexible. I can change the budget based off of the percentages. And we call those levels of activity, right? And so that's the nice thing about having a flexible budget is you're able to do that. Total variable cost change in direct proportion with the changes in the levels of activity. So once I cross that 100% threshold, I'll then adjust my budget to 125%. Or if I think I'm not going to hit that 100% sales mark of $100,000, I might adjust my sales budget downward to 75%. That's the beautiful thing about having the flexible budgets. You can change based off of those expectations. Total fixed costs will, of course, will remain the same regardless of the level of activity. You know that. So, variable costs change with the level of activity. That's your direct materials, direct labor, factory overhead. Those things change with the level of activity. They go up with the greater activity. Fixed costs remain the same regardless of level of activity, meaning the sales manager's salary will stay the same regardless of whether we sell more or less. It's a fixed cost. The rent will remain the same regardless of whether we sell more or less. It's a fixed cost. So fixed costs remain the same, but the variable cost will change with the level of activity. And as that happens, I can also adjust my budget accordingly. Here's a visual representation of what I'm talking about. So here we have a flexible budget. We have sales, we have variable costs, and fixed costs. Remember, the fixed costs will remain the same regardless of the level of activity. However, my variable costs will rise or fall with the level of activity. So if I create 10,000, if I'm going to create a flexible budget, I'm going to create what we call levels of activity. The lowest level of activity here is 10,000 units. the mid-range or middle, low, medium, high, whatever you want to call it. The low is 10,000, the medium is 12,000, and the high is 14,000. These are units, right? And you can see that my sales, if I sell 10,000 units, 100,000. If I sell 12,000 units, 120,000, 14,000 units, 140,000, etc. It's $10 a unit. We can also see, based off of those levels, the changes in the variable costs. Direct materials, 10,000, goes up to 12, goes up to 14. It's $1 per unit. So my variable cost will increase with the changes in the level of activity. My fixed costs will remain the same. But it's important to note the changes at each level. This is what allows us to have a flexible budget. So if my sales end up being 120,000 instead of 100,000, well, I can simply increase my flexible budget to be in alignment with those increases in the variable costs. In other words, I could set it from low to medium. So let's say we expected to sell 12,000 units. And I actually sell 12,000 units, but there was a change in the sales price. So instead of me selling at $10 a unit, I sold a little bit more than that. So I got a variance, favorable variance, my sales. How do you find the variance? You take the actual minus the budgeted amount. That's how you find the variance. We can see going down, we have mostly, well, we have a mix between favorable and unfavorable variances. Direct materials, direct labor, the actual came in higher than the budgeted amount, so that's unfavorable. Factory supplies came in 300 less than the budgeted amount. That's favorable. When your actual is less than the budgeted amount, it's usually favorable for expenses, not for sales. Right? You want your sales to be higher than the budgeted amount. But we can see that for a cost, if you come in under the budgeted amount, it's favorable. If you come in over, it's unfavorable. Our total variance is favorable, 3,000. How do we find 3,000? Your sales minus your total variable cost, or minus your total fixed cost, will get you your total variance, income from operations, 3,000. So it's good to kind of see the contrast here, right? So, and that's really how flexible budgets work, is we look at the variances and we identify the total changes. And that's how we're able to make adjustments according to the changes in output. Now let's talk about the standard costs. Standard costs are, earlier I had said I think of it as being the expected cost. The expected cost, the standard cost. It's my budgeted cost. That's what I expected to come in at. That's standard cost. That's like the most basic way of thinking about standard cost. The standard costs are based off of what we normally expect that cost to be. It's based off of the expected level of performance. And I use standard cost for direct materials, direct labor, and factory overhead. My standard cost for a piece of wood is $1. My standard cost for an hour of labor is $10. My standard cost for the overhead for utilities is $3 an hour, etc. Standard cost. It's what I expect it to be. Standard cost. Setting standard cost depends on a couple of things. Usually averages for the most part, but setting standard cost depends on the standard price and the standard quantity when we're talking about materials. The standard price and the standard quantity for direct materials. For direct labor, it's the standard rate and the standard amount of time it takes to complete a job. For variable overhead, it's the standard rates and the standard activities. Ms. Rhodes.
Yes, okay. But I was about the direct labor. Okay, so the standard rate of the is that the hourly rate?
Yes, ma'am. Yep. So it's the standard rate is the hourly rate. That's correct. So
Okay.
and the way we get that standard rate, Ms. Rhodes, is we look at our hourly employees that are performing the task, right, the job, and we say, okay, so let's say we have like a garment factory. In our garment factory, we have sewing machine operators, and we say, okay, the average sewing machine operator at my garment factory makes $12 an hour. That $12 an hour becomes the standard rate. We
Okay.
know, Ms. Rhodes, that sometimes our employees work overtime. And so
Right.
that the actual rate might be higher than the standard rate. And we'll talk about that because that's what we
Oh,
call a rate variance.
oh, okay.
Excellent question. And I know where you're heading with that, so that's great.
All right. Thank you.
You're very welcome. So let's take a look at an example here. We have an example of a company that makes baseball bats, right? Yeah, baseball bats. Okay, so our company makes baseball bats, and we have standard costs for wood. We have a standard dollar amount per hour for labor, and we have a standard overhead rate. So to make one baseball bat, or cards, what are we making? I don't know. We'll say it's baseball bats. Uh, uh, we use 1 kilogram of wood, takes 2 hours of labor, and the overhead rate is based off of labor. So it's 2 labor hours. The standard cost of a kilogram of wood is $25 per kilogram. The labor is $20 per hour, and the overhead is $10 per hour. So we simply take the quantity times the cost per unit to get the total standard cost. Quantity times the standard cost per unit to get the total standard cost. 25 for wood, 40 for labor, 20 for overhead. Total standard cost of being $85. Now that we know what the standard costs are, we would then identify the actual costs and find variances. So let's find those variances. A cost variance, as I had said earlier, is the difference between the actual cost and the standard cost. Actual minus standard, budgeted amount, is how we find the variance. If the actual cost is greater than the standard cost, it's unfavorable. It means the costs were higher than what I expected them to be, right? So that's unfavorable. However, if the actual cost comes in less than the standard cost, it becomes favorable. So one of the things we want to do as business managers, owners, accountants, is to identify these variances and analyze them. Well, why do they happen? So the first thing I do is I prepare the reports, the financial statements. I look at the differences in the costs, right? I look at the differences in my variable costs. I start to ask the questions, well, why did these variances exist? What caused these variances to happen? Oh, did my supplier raise my prices? Oh, did I raise my sales price? Did I lower my sales price? Did my cost of labor rise? Did my cost of materials rise? These are the questions we ask, right? Based off of the variances. We answer those questions, and then we take corrective action. So, we might have to raise our sales price if our variable cost went up, right? So these are the kinds of analysis we go through on a regular basis with a variance report. So we compute the variance by taking the actual minus the standard. We look at the questions and answers, and we take corrective actions if they're needed. So let's talk about how we compute those variances. Computing the variances is used in a relatively simple formula. It's the actual cost minus the standard cost. Well, first you got to figure out what is the actual cost. The actual cost is the actual quantity times the actual price. Actual quantity times actual price will give you the actual cost. Makes sense, right? The standard quantity times the standard price will give you the standard cost, or the budgeted cost, whatever you want to call it. We take the actual cost minus the standard cost to get our total cost variance. And this is the formula. And we use this formula for direct materials, direct labor, sometimes overhead. So the actual quantity times the actual price will give us the actual cost. The standard quantity times the standard price will give us the standard cost. The actual cost minus the standard cost gives us the cost variance. We typically do this for both materials and for labor to find the cost variance. Actual cost minus the standard cost gives us the cost variance. There are two different types of variances we need to find. The first is the price variance, the difference in the price. Now we know the difference in the price is the actual price minus the standard price. To find the actual price, we take the total price variance. We take the actual quantity times the actual price, how many we actually got, right? Minus the actual quantity times the standard price. That gives me my price variance. I find a very similar variance for quantity. The actual quantity times the standard price minus the standard quantity times the standard price. That gives me my quantity variance. I take my price variance and the quantity variance. Actual cost minus standard cost to get the cost variance. I could get the price variance minus quantity variance to get the cost variance. It's really just a matter of plugging in the values, right? But really, this is how we find the variances. And again, it's important to understand what the variances are because as managers, we need to then decide whether we need to take corrective action to resolve any types of variances. The standard quantity is the quantity that should have been used for the actual good output. Remember, the word standard means what it usually is. The standard. Oh, that's what it normally is. Standard. Standard price. Oh, that's normally what I paid for that unit. The standard quantity. Oh, that's the normal amount I usually get. Standard. Actual is what actually happened, right? That price might be higher or lower. The quantity might be higher or lower. So the first thing we want to do is find the price variance and the quantity variance. We find the price variance by taking actual quantity times actual price. And then we take the actual quantity times the standard price. That gives me my price variance. Then I find my quantity variance. Actual quantity times standard price. Find that first. Then I find my standard quantity times my standard price. The difference is give me the price variance and the quantity variance. And that's the standard price is what I should have paid. Right? That's the standard, yes? That's what I should have paid. But so usually not what I actually paid. It's a relatively straightforward computation. Actual quantity times actual price. Then the actual quantity times the standard price to get the actual cost. The price variance. Actual quantity times standard price, find that. Then the standard quantity times standard price, find the quantity variance. It can be broken out this way as well. Actual price minus the standard price, find that first. That's what the little parentheses mean in the PEMDAS, right? We talked about this. The PEMDAS, the parenthesis, it's the order of operations for mathematics. So the actual price minus the standard price. And then you first find that, then multiply that by the actual quantity. That'll get you your price variance. Then we find the quantity variance. Actual quantity minus the standard quantity, and then we multiply that by the standard price. That'll get you your quantity variance. So it's important that we're able to compute these. So we'll run through a couple of examples. First, we'll do materials. Okay, so we make golf club heads. That's cute. So I'm making golf clubs. So in order to make a golf club, I need some materials. So I have some information. $10 direct materials takes an hour per unit at $16 per hour, so $16. So it takes 1 hour to make one golf club, apparently. And that gives me a standard direct cost per unit of $26. Direct materials plus direct labor gives me my direct cost per unit, standard direct cost per unit, $26. We look at first the materials variance and then the quantity variance. So we use this information. So we produced 3,500 golf club heads using 1,800 pounds of material. It's $20 a pound. So we pay, however, the standard rate for materials is $20 per pound. We actually pay $21 per pound for the material. Why? Because the market price went up. So let's compute the variance. Now the standard is $20 per pound. 1,800 pounds, $20 per pound, that's 36,000. The actual was $21 per pound. So 1,800 pounds times $21 per pound, 37,800. Yeah, that's a lot. uh, but instead of actually getting 1,800 pounds, well, I got my actual was 1,800 pounds. My standard quantity is only 1,750 pounds. My standard quantity is only 1,750 pounds. That's what I normally get, not 1,800. So I got 50 pounds more than what I actually get. At $20 per pound standard price, it's 35,000. So first we find the price variance. The price variance is the actual minus the standard. So 37,800 minus 36,000 is $1,800. It's an unfavorable variance. Remember, it's unfavorable when the actual cost comes in above the standard cost. What about the quantity variance? Well, remember, I got 50 pounds more than what I normally get. So I take the actual quantity and the standard price, 36,000, minus the standard, 35,000. My quantity variance is $1,000 unfavorable. Remember, it's unfavorable when the actual is above the standard. So that means my total variance is 2,800. Price variance plus the quantity variance is $2,800. Unfavorable. That's above, again, the standard. So who gets in trouble? Right? Management always likes this question. Who gets in trouble when there's a large variance that's unfavorable? Is it the employees? Well, no, they're just doing their jobs. Is it management? Well, they don't set the prices. Is it a combination of the supplier, management, and the employees? Maybe. That's one of the things that we do as managers is we try to identify the problem and find a solution, especially when there's a great variance. But now that we understand the variances for materials, we need to understand the variances in labor. Now, the employees work actual hours at an actual rate. But we also have standard hours and standard rates. When we talk about hours, it's the hours worked, right, or expected to work. The rates, that's their hourly rate. So we can find the rate variance by taking the actual hours times the actual rate minus the actual hours times the standard rate. And the formula could also be expressed by saying actual hours times the actual rate minus the standard rate. Remember the parentheses, you do the parentheses first. Yeah? So that's our rate variance. We can also find what we call an efficiency variance. Efficiency variance shows us how efficient our employees are using those hours, their efficiency rate, if you will. The efficiency rate is the actual hours times the standard rate minus the standard hours times the standard rate. This can also be expressed by saying the standard rate times the actual hours minus the standard hours. That gives us our efficiency variance. So let's take a look at our example to understand our labor variances. If we produce 3,500 golf clubs in 3,400 hours, that's actually pretty good. And the average hourly rate actually paid was $16.50 per hour. Let's take a look at the variance. Now remember, our standard is 1 hour for each unit at $16 per hour. So let's take a look at the variances. The actual cost. Actual cost, so actual hours was 3,400 hours. I budgeted for 3,500. My actual hourly rate was $16.50. I budgeted for 16. So my actual cost was 56,100 minus the budgeted amount. Minus the budgeted amount. Actual hours times the standard rate, 3,400 times 1,600. I'm sorry, $16 is 54,400. The standard cost, which is the budget amount, I budgeted for 3,500 hours at $16 per hour. It's 56,000. So I can already see, even without doing the computation, it might be unfavorable by about $100, right? So let's take a look. The rate variance was $1,700 unfavorable. $1,700 unfavorable was the rate variance. The efficiency variance was $1,600 favorable. Favorable. The reason why the efficiency variance is favorable is because the standard was greater than the actual. Right? 56,000 minus 54,400 is 1,600 favorable. So that's pretty cool. So my efficiency was favorable. However, my rate variance was unfavorable. And we know that it's going to be unfavorable by $100. How do we know that? Because 1,700 minus 1,600 is 100. And it's on the unfavorable side. Make sense?
Yes, it makes sense.
All right, cool. Why was the rate 16.50 and not 16.50 instead of $16? Why was the rate 50 cents higher? Well, maybe I had some more skilled employees that I pay more for higher skilled employees. So that could be one of the causes for the unfavorable rate variance. Uh, Even though they were able to do more in less time, it's still unfavorable rate because of the 50-cent difference. So there's a couple of reasons why that could happen, but this just kind of explains one of the reasons for an unfavorable rate variance. Who's responsible for managing labor cost? Is it HR? Is it the production managers? Is it uh, the company as a whole? There's a lot of different reasons why labor costs will be different. The actual cost will be different than the standard cost. Uh, it could be training. It could be that we got too many skilled employees and not enough unskilled employees. There's a lot of reasons, right? But this just kind of looks at it's the question and answer, right? It's like, oh, okay, well, here's what happened. Here are the changes we need to make, etc. when it comes to variances, they can be controlled to some degree. It's not easy to control variances, but we can look at our variances and learn how to control them. There are variances in overhead as well. We most time overhead is based off of a predetermined overhead rate. We talked about that a few weeks ago. We talked about predetermined overhead rate. We talked about how the predetermined overhead rate is assigned. It's usually based off of some type of activity. Oftentimes, it's based off of hourly employee rates. That's the estimated activity, the activity base. So to find the predetermined overhead rate, we take the estimated total overhead cost, the budgeted overhead cost, divided by the estimated activity, number of employee hours. To find the assigned overhead rate, we take the predetermined overhead rate, which is usually expressed as a percentage, times the standard activity, number of employee hours for a job, would be the standard activity. We allocate the standard overhead rate to our products and services that we're manufacturing. And it's done in a three-step process. Of course, the first is determine the standard overhead rate. Then we find the assigned overhead amount, and then we compute the standard overhead rate. So determine the base, choose a particular level of activity, compute the rate. The allocation base, that could be number of employee hours. Level of activity, number of hours it takes to perform a single job. And then we compute the overhead rate. With flexible budgets, that the overhead rate might change based off of the level of activity. Here's an example of how the predetermined overhead rate per hour would change with the level of activity. And why would it change? Well, if there's more labor involved, then of course the overhead rate will change because it's based off of labor hour rates. So we can see based off of the amount that we can produce at each level, what the changes are in the overhead rate. 70%, 80%, 90%, 100%. So those are the levels of activity. So if we predict that we'll produce 80% of what we're expecting to do, then my predetermined overhead rate would be $2 per hour. How do we find that? Well, the standard overhead rate is 8,000 divided by the 4,000 direct labor hours. You get $2 per direct labor hour of overhead. As you know, a variance is the difference. That's what the word variance means. It means difference. And we found the variance for materials, the variance for labor. Now we're looking at the variance for overhead. Find the variance for overhead. We're taking the actual overhead incurred, the actual overhead rate, minus the standard overhead rate. Actual minus the standard gives us the variance. So, looking at this example, the actual overhead incurred was $7,650. My standard overhead rate was $7,000. That means I have an unfavorable overhead variance of $650. Remember, it's unfavorable if the actual cost is greater than the standard cost. The volume variances work very similarly. Volume is the amount, the quantity. Okay, that's volume, quantity. The variances for overhead in terms of volume is based off of the actual units produced. We apply the overhead cost variance by taking the actual overhead minus the standard overhead. The total overhead variance is the actual minus the standard. The overhead controllable variance is the actual overhead minus the budgeted overhead. And the overhead volume variance is the budgeted fixed overhead minus the standard fixed overhead. That gets us to the total overhead variance. Looking at our example, our total overhead variance is $650. Our overhead volume variance is $500, giving us a controllable unfavorable variance of $150. Overhead volume variances, we take the budgeted minus the applied to get a volume variance. Volume variance is unfavorable by 500. Oftentimes, when we're talking about flexible budgets and variances, it all goes back to this. All goes back to the sales budget. Remember when we talked about budgets originally? We had last week. We talked about everything starting with a sales budget, and with everything starting with a sales budget, the variances oftentimes start with the sales, the variances in sales. We can make adjustments based off of the changes in sales. So here we go. We expected to sell 1,000 golf balls. We actually sold 1,100. The sales price was the expected sales price was $10 per box of golf balls, I guess. The actual sales price was $10.50, so we sold it for 50 cents more than we expected. We also sold 100 units more than what we expected. We expected to sell 150 driver, which is a golf club. We expected to sell 150 golf clubs. We only sold 140. The sales price was expected to be 200. We put it on sale for 190. We can see a couple of variances already in the sales. So remember, actual minus the standard, yeah? So using the actual minus standard approach, we have a $550 favorable variance for golf balls. How do we find that? Actual sales times actual price minus the actual sales minus the or times the budgeted price or standard price, if you will. The difference is $550. And that's favorable because, well, we sold it each box of golf balls for 50 cents more than what we anticipated. We also sold 100 more than what we anticipated. So the sales price $550 favorable variance the volume variance is $1,000 worth of favorable variance. With respect to the golf clubs, those were definitely unfavorable. We didn't sell as many as we expected, and we sold it for less than what we expected. So definitely both going to be unfavorable. And remember, it's just a matter of plugging in the values into the formulas. We can account for variances for spending as well. You know, even on the income statement, we could look at those variances, right? The budgeted performance compared to the actual performance on expenses. So we can identify variances for those for spending as well. This kind of shows us the flow. It's one of those flow charts. This one I'm not a big fan of. It's a little confusing. But the overhead variances are pretty straightforward. You know, we're taking the actual minus the applied or the expected, and we can see that the difference in overhead variance. That's what variance means, difference. So how do we find the actual? I'm sorry, the variable overhead variances. Well, we take the actual variable overhead incurred, or just the actual, divided by I'm sorry, we take the actual overhead times the actual variable rate minus the actual overhead times the standard variable rate to find the spending variance. And then we find the efficiency variance, actual overhead rate times the standard variable rate minus the standard overhead times the standard variable rate to find the efficiency rate. So looking at our example, we can compute the variable overhead spend and efficiency variances by plugging in the values. Oh, sorry. That's what I wanted to show you. Yes. Okay. So the actual overhead times the actual variance rate, 3,650. The flexible budget for variance, 3,400 hours times $1 per hour, 3,400. We can already see that that would be unfavorable by 250. 3,650 minus 3,400 is 250, unfavorable. Why is it unfavorable? Because the actual is greater than the budgeted amount. The efficiency variance, on the other hand, was favorable. The actual was 3,400. The standard was 3,500, so that's $100 favorable. But the total overhead variance was unfavorable by 150. 250 unfavorable minus 100 favorable is still 150 unfavorable. The fixed over, looking at the difference between the spending variance and the volume variance really does give us a pretty good understanding of the fixed overhead variance. Remember, it's all about finding the differences, and that's what variance is. It shows us how efficient we're being. It also shows us the differences in the actual minus the budgeted amounts. And this is pretty much the same example I showed you earlier. It's slightly different because we were able to make adjustments based off those variances. That's why the spending variance is now 0. For fixed costs, as you know, fixed costs do not change regardless of the level of activity. Those will remain fixed. They do not change regardless of the level of activity. However, there will be an inflection point between the fixed cost and the variable cost. And we can find the variable and fixed variances by plugging the values into the formulas. Remember, the variances are important for managers, for business owners, for accountants to really get a gauge and understanding of the differences between the actual performance to the budgeted performance. A couple of journal entries they're basically adjusting journal entries that we would make at the end of the month, and it's based off of those variances because the variances do need to be accounted for because they ultimately do have an impact on inventory. And the reason for that is because we typically budget inventory as at the standard cost, and it might come in differently, at an actual cost uh, for things like raw materials inventory. And so this is an example of one of those adjusting journal entries that we would make at the end of the month to record those variances. Here's another example of recording those variances. And of course, we can also get a pretty good determination of variances by simply looking at the income statement and comparing the income statement performance to the budgeted performance. That, my friends, is the end of our discussion on flexible budgets and standard costs. Now, we got through that pretty quick, didn't we? Any comments, questions, concerns? It's pretty straightforward overall. It's just a matter of plugging in the values. Ms. Rhodes.
Yes, pretty much. I was gonna say yes. As usual, make it pretty much understandable. Because I did get a little confused with the labor costs, analyzing doing it that way. That's why I asked you that question about the labor when we
Oh,
came to
sure.
that
Yeah.
part. But
Yeah.
now you made it more understandable. It's understandable now.
Yeah, I can see how that could be confusing. And again, it's all about understanding the differences between the actual versus the standard, right? It's like, for example, if I plan to spend $16 per employee for labor, right, per hour, and I hire someone that they're a little faster, and well, I'll actually pay them 50 cents more per hour. So the actual minus the standard gives us a variance of 50 cents per hour. And so that's, one of the variances for labor. And you're right. It can be a little confusing at times if you don't quite understand the concepts between actual the standard. Very true.
Uh, Thank you.
You're very welcome. Are there any other comments, questions, or concerns? Y'all still awake? I know it's lunchtime. Okay. Uh, just to kind of recap where we are in the classroom, let me share that part of my screen. Hold on just 1 second, please. Share screen. I'm going to show you the classroom. In the classroom, we are in Module 3. We are in Week 10. The PowerPoint presentation is there. The quiz is there. Remember, every homework assignment and every quiz in this class, you got 2 attempts. So if you're not satisfied with one of your grades on a homework assignment or a quiz, remember there's that second attempt. Make sure that you use that because I want you to do the best that you can in this course. So please make sure that you complete the Chapter 23 quiz by Sunday night. And also to give you a bit of a preview of where we're heading. Next week, we'll have chapter 24. Following week, chapter 25. And then 3 weeks from today, we'll do chapter 26. Believe it or not, we are quickly approaching the end of the semester. The end of the semester is technically at the end of April. The final exam, as of right now, we're looking at April 25th. The final exam will cover chapters 22 through 26. Be straightforward, just like it's always been. It's a relatively straightforward course, and so that's where we're heading. We're heading in the right direction. So yeah, as always, if you have any comments, questions, or concerns, remember you can always email me, call me, set up office hours. Office hours links right here. The tutoring is also available. Feel free to set up tutoring if you don't understand any of the concepts. You can set up office hours with me, and I'll help you to understand the concepts even better. Or you can always email, call, whatever it is. I'm here for you 100% of the time. So having said all that, as always, please stay safe, wash your hands, do the right things, and I'll see you all again, same time, same channel next time. Thank you all so much for your time today. Appreciate it all.